Market measures, part 3, zero DT timing. 24 marked our first full year of gathering the zero DT data at Tasty. Market measures are a chance to share the results with you in depth. As we head into 2025, we're going to review some of our best zero DT research of 24, and we're going to explore the importance of timing when it comes to zero DT trades. So, our study, using 1 year of data in zero DT SPX options collected every 10 minutes for 15 years worth of data in the 45-day options. So, in the zero DTs, it's whatever it is, 20 months, and in the other data we're going to show you is 15 years. We examined selling strangles with 20 delta legs, both at the zero DT market open and 45 days to expiration. We contracted the hourly performance as a percent of the initial credit for the zero DTs and the weekly performance of the 45-day to expiration trades. Next slide, please. A lot of stuff here. This is old stuff, so we're just showing you. This is weeks versus hours, okay? The first one, 45 days to expiration, strangles. First 2 weeks, average P&L change, 11%. Second 2 weeks, 24%. Third week, tough one, -2. And then the final week, +16. Standard deviation of change, you can see the first week, the key is the last line, the standard deviation of change. 6% is very manageable. 12%, very manageable. 28 and 53, that's where it gets tough. It's not worth the return at that point. Let's go to the next slide. And this one, we're going to show you zero DTs. So in the zero DT strangles, it's the same thing. Look at the last line, standard deviation of P&L change. What's interesting here is that the first 2 hours, 19%.
Manageable.
Second 2 hours, 34%. The third 2 hours, 56%. And then the final hour, 153. Swinging. Yeah, you're just swinging.
You're just swinging it.
153. Now, I'm not saying -5 in your average P&L the first 2 hours, nothing great, okay? But the second 2 hours, that's pretty damn good. So in that first 2 hour period, there's a chance to make some money. It's not worth the risk holding to the end of the day. At 19 and 34%, very manageable. 56 to 153, not so much. Both the zero DT and the 45 days to expiration trades had more stable prices early in their lifespans, as measured by the lower standard deviation of returns. That's what I showed you. For both, managing winners to capture early success were the more beneficial mechanics. For early in the zero DTs, it just means the first few hours, instead of the first few weeks for the 45 days. For handling losers, the zero DTs gave more opportunities for traders to succeed using their own style. More risk-tolerant traders could choose to stay in losers and hope for recovery before the close. Did this late-in-the-day success mean it was a good idea to trade zero DTs even if you missed the market opening? Next slide. Let's have some fun. This is our kind of fun. So using 20 months worth of data in the SPX zero DTs. Now, people that have a smaller account that want to trade without pattern day trading rules using the ES options, same exact thing. It's not cash settled, but it's the same underlying product. ES, SPY, SPX, they're all the same. MES, XSP, they're all the same. But some have pattern day trading rules, some don't. We examined selling zero DT strangles using the 20 and 30 delta strikes at market open, 10 a.m., noon, and 1:30. All the times are Chicago times, CT. All the trades were managed if they reached 25%. Losers that didn't reach 25% were allowed to expire. All trades were assumed at mid-price. Let's go to the next slide.
Okay.
So you can take a little off if you want. Here's your 20 delta strangles that were, these were just on the zero days. Placed at market open, you made 89% win rate. Placed at 10 a.m., 88. So it didn't matter what time you placed for the win rate. What it mattered for was how much money you made. And the average P&L is significantly higher if you put your trades in early in the day. Period. That's it. First 2 hours. 30 delta strangles, exact same thing. Everything happens P&L wise in the first 2 hours, or the majority of it. So since we started trading zero DTs in 23, they have been consistently profitable for short premium traders who took profits early. Choosing strikes by delta automatically adjusts trades for the current volatility levels and the time remaining in the contract, giving consistent success probabilities and helping retail traders expand into new arenas with confidence. While the zero DT trades had more success stories for those who held on through expiration than the 45-day trades, placing new trades late in the day was detrimental, just like placing new trades late in a cycle can also be a little bit detrimental.